And that's where I see the problem is that we have changed or broken down the mechanics of the whole financial market so much that we have brokers who say we're market makers and that's how we can offer you better conditions, trading conditions. Fair enough. But when you go against the rules of nature, where you offer zero spread and you offer swap free and you offer this and you offer that, and you do not adhere to the rules of the market, or you do not vet through your flow, okay, fair enough. You have a profitable trader, he's really good at trading, I'll put him in the other group, charge him a little bit of spread. So there's at least you can have that spread, you can capture that value in the spread.
Here we are. This is another podcast, The Financial Frontiers. My guest today, Elina Pedersen. Thank you for joining me.
Thank you for inviting me.
Yes.
It's great pleasure to talk to you,
yes,
as always.
I'm looking forward to it. I think we've got a lot of really useful insights to pick out from your brain. Welcome to the humble studio of Financial Frontiers.
It's lovely, and it's great to be here. Today it will be a bit more public than our standard private conversations. Right?
Yes. And the whole idea of this is that we make public what we talk about behind the scenes, and I think there's a lot of really useful information here that could be beneficial to the end trader. So, Elina, please introduce yourself.
Sure.
Let us know who you are. Go as far back as you want, and let's build up your experience up until where you are currently, your Bourse.
Thank you. So, my name is Elina Pedersen. I'm the Chief Revenue Officer and co-CEO of Your Bourse, a technology provider who offers matching engine and, in general, trade execution technology with risk management and different things that can help brokers succeed, especially in the challenging markets. I used to be the CEO of Admiral Markets in the past, as well as the Chief Marketing Officer before that, and the Head of Marketing before that, and Marketing Manager before that, and Advertising Manager before that. So I have a lot of experience in understanding how brokerages work, looking at both concepts from both the end client point of view and understanding the value that the broker can provide to the end clients, as well as from understanding what value can broker derive from those customers. So kind of 360 approach on the whole brokerage space. That's pretty much where my experience lies.
So mainly around marketing, if I've understood correctly.
Initially, yes. Initially, it was marketing. So if we really go back to my education, I'm a marketeer by profession. And I worked in different fields, in publishing, in even education, a lot of things. But at some point, I've traveled around, right? So I studied in the Netherlands and Australia. I lived in the US, I lived in the UK. And at some point, I was really homesick when I was graduating. I was really, really homesick, and I really wanted to go back to Estonia. I'm originally Estonian. And there was a point where also, at that point, I lived in the UK. And I was working in education, but I had a lot of friends marketing in the education. I had a lot of friends who worked in the city. And I thought, damn, this is so much more rewarding. In a way that the salaries, if we look at them, were 30-40% higher than in anywhere else in media, in marketing, in advertising, education, anywhere. And I thought, oh, this is interesting. It feels like this is something I want to explore. But I also wanted to go to Estonia. And when I came back to Estonia, I was quite sure that I wanted to do that for at least a year because I'm really homesick. I came back to Estonia and I was like, okay, so what do we have here in the financial space, right? What does the market has to offer? And of course, there were a few banks, old-fashioned kind of banks. there was Admiral Markets, and it was quite a fresh firm back then still. I think they just received their Estonia FCA license, so it was still under MiFID, so European Union. And I think the same year TransferWise was founded. Vice, but I didn't know about it then. It was just a couple of months it was founded for a few months when I started looking, so it wasn't around, So, one thing you need to know about Estonia is that everybody knows everybody. It's a really small country. We are 1.3 million people, and
that is small. I didn't know it was so small. Okay,
it is really small.
Wow.
And if you want to find some connection between people, all you need to do is you need to know who you're looking for. So it turned out that my brother, he studied with one of the owners of Admirals, and also one of his friends from university was working in Admirals. So it was really easy to get an introduction. But to be honest, they didn't have a role for me. They didn't have a marketing department when I started.
Okay. Wow.
Well, they had some local, one thing you need to know about Admirals is that they are super global, right? They would really go and they would speak the same language as the clients do. They would do their utmost to service the clients. They really care about the clients. Now, so they had those smaller marketing people, I'd say sales/marketing, that would be doing the local things, but they didn't have a global marketing at that point. And I remember I went to the website and I wrote this massive letter to them. I just got an email from my brother and I wrote this massive letter to them saying how I would improve it, saying, okay, this has to change, that has to change, so on. And I was called for an interview. And that was very funny because the interview was 2 of the owners and 1 additional board member.
Okay.
And I just graduated, but I was fine,
Cool.
And they hired me. They made a role for me. They hired me as an advertising manager. I quickly progressed into marketing manager, then the head of global marketing, then the chief marketing officer, and then the CEO of the UK entity. So, and after I became a non-exec. So I've been with them for 7 years.
When did that start? What year was that?
That was 2010 or 11.
Okay.
Yeah, so it's quite a few years back. Yeah. So that's where my career started. Now, I also managed to marry within the industry, which trust me, my family dinners are not fun. Anyways, so I was introduced to my husband and the founder of Bourse, and before that, one of the owners of Alpari Group, by Alexander, who is the owner of Admirals. And fast forward, we kind of built a family. It was not planned.
Okay.
It was funny, we both had to get approval from compliance.
Because you're in different entities and conflict of interest.
Yes,
wow.
exactly. So it was quite hilarious, but there was a moment when I've left the industry for a year or 2, and it was after the S&P event of 2015, because it was all really disappointing for me. Simply, do you remember the S&P event of 2015?
Yeah.
Are we all enough here?
Everybody remembers it quite well.
All right, okay.
So, just to build the context there, so I just want to clarify that acronym is SNB, right?
Yeah.
Swiss National Bank.
Yeah.
All right. I actually just found out now. Thank you for sharing that. But I definitely knew about the event, and just to build the context for the audience, it's when the Swiss franc was pegged to the euro, and what that means is whatever the exchange rate of the euro is equals on par to what the Swiss franc was.
It was 120. So
120. So it was locked at that price. Euros went up, and accordingly the Swiss franc went up. If it went down, accordingly went down. And so that obviously links to, the exchange rate of the Swiss franc is linked to the macroeconomics of the eurozone generally. And then the S&P decided one day
that they're going to remove it.
We don't want that anymore.
Yes, but the funny thing about it was that few days before it, they literally said, I mean, you can find it on the internet, no problem. They literally publicly said that this is the cornerstone of our financial policy.
Wow.
This is a quote.
So they got everyone off guarded.
Yes. They said, this is the cornerstone of our financial policy. So obviously, and we're talking about dozens of brokers, large brokers, biggest brokers in the industry, being regulated by the FCA, the many regulate, but the FCA, I guess, was the most popular at that moment. And their risk departments going, this is the cornerstone of their financial policy. Yeah. So we have that exposure. So what we're going to do, we're going to take it to the market because it makes sense, And what they did, as we've reached the cap, they removed it.
Oh my.
And of course, it was a black swan. There were a lot of technologies that couldn't cope, because it was just, the market wasn't there. It was quite crazy because the way the banks were quoting it, the industry wasn't ready for that. So we found a lot of brokers breaching their capital adequacy rules because what they did is they took it to the market while their traders also knew about the cornerstone of the Swiss financial policy, right? So they ended up being in debt to those brokers. But when the brokers were working directly with their prime broker, the bank, that's one-on-one, right? In a way, a one-on-one relationship. But when you're a retail CFD broker, you have thousands of clients owning you money. And you can't collect it quickly because if you're in breach of your capital adequacy, then what happens? The regulator calls you and says, please report on your financial situation. And you go oops. Yeah. And the other problem that drove a lot of brokers into issues was that they wouldn't allow external investments. So if you wanted to get someone to invest and cover that hole externally, they would say, they need to pass a due diligence and we need to do it. And that would take 6 months. But you're in breach now. So cover the hole yourself, or you have to go into administration.
Wow.
And that was, to me, a massive event because I kind of loved the way the industry was back in the day. I loved the fact that brokers had their relationship with the banks, that they had a PB, that the market was real, that you could potentially have different banks streaming the pricing to you, and based on the best bid and ask, you would have negative, the difference would be negative. So it would be minus 0.8 of a pips on Euro USD. So you could really offer good conditions to your trader. You could say, okay, it's zero spread, but there was enough spread for you in offering these conditions to the brokers. Where today, that's not what it is, because there are not, I can really I have enough fingers on my hand to count the brokers who still have a PB relationship with the bank.
Right. And they're actually doing it correctly. So, yeah, I mean, you covered a lot there. And it's so interesting. I think there's, these things that happen, like the black swan events that caused really big brokerage firms who were actually operating proper legitimate business back then to eventually close down. It's this perfect storm, right? So first starting off from the black swan event, and what a black swan is an unprecedented major event that happens that nobody anticipated, and it actually causes the markets to shift and move very drastically up or down or whatever it is. So the perfect storm is that black swan happened, and then as a result, the brokers had the capital adequacy to adhere to, which capital adequacy, as we know what that is, and that's basically the broker needs to have at all times in a bank account, the money enough to cover what their clients, what is owed to the clients, what their position is. So, if your client's money with you is a certain amount, and they're trading actively up and down. You need to be able to, if you have to push the stop button, the clients can get their money back. That's what the capital adequacy is. And it gets really tricky when there's a black swan event and then the positions swing way down where you didn't anticipate such a big drop. Because obviously, brokers of businesses, that you can't just, for capital, to adhere to capital adequacy, just put all your money there. You need money for operational costs or whatever it is. And there's also, different ways. Clients deposit the money. You just make sure that that's kept in banks that are...
And you reconcile. You see what your position is.
On a daily basis, whatever it is.
Yeah.
On a daily basis. And the black swan events, the change could happen in literally seconds.
Yeah, we're talking seconds.
Yeah. So... and then, in terms of perfect storm, that given the nature of the broker, where can I use the term liquidity in terms of can the clients want their money now? You need to give it straight away, right? That condition on top of the FCA, pressing the broker to be able to cover that, they just weren't able to. And then,
No, it's not even that. Like, a lot of them were able to cover that. But what happened is that they owed money to the bank.
Right.
So even if they had enough money in the client bank account, which they did, they still have a hole because they own money to the bank.
Because that's where the flow was. Yeah.
Exactly. So, and that made, what happened then is that, well, first of all, regulators were like, oh, this is a very, very, very difficult industry. I don't know. It's retail clients. We need to protect them. But instead of protecting them in the way that they used to, where I think they were really protecting them and treating customers fairly and making sure that the best execution rules are applied, what happened is that they pushed a lot of brokers offshore.
Right.
And they started scrutinizing the industry. And that's what we saw. And that's where my disappointment came from, right? Because you didn't have that clear, transparent rules of how to run a prudent business anymore. And you didn't have to have the end client's interest in your mind all the time anymore. It was more of, okay, we're going offshore and we're going to do whatever we like. And to the point where people didn't even look at the capital adequacy anymore. They thought, oh, our net deposits, is that what we made?
Yeah, and that's not the way to run the brokerage. Yeah.
Exactly. But unfortunately, we see it more and more. And I think that's what really made me kind of reconsider if I want to be a part of this industry. So I went to have a short break. I was on maternity leave until, meanwhile, and Andre, the founder of Your Bourse, and my husband, he's a true visionary, right? He founded El Pari, I can't even remember where it was, but that was like several decades ago, I think.
Yeah, they were one of the first. Does it date back to like even 2000?
It's earlier than that, I think.
Oh, wow.
Yeah. They were one of the first brokers to ever use MetaTrader. But he exited in 2015, right? So he exited after the S&P event because he had this vision of creating a technology provider that could help brokerages give that value to their end client, but still have the client interest in mind. So running the business fairly and allowing them to stay competitive in a difficult market, but not by abusing the traders, but just by having a good technological stack that would allow you to do it the way that banks have, and the way that tier 1 brokers do. So he had that vision and it was brewing in his head for a while. He even registered a company like even before the S&P event, I think. But we didn't start on it for a long while, I think they started writing the code in like 2017 probably.
He's a coder.
He's also a programmer, yeah, and he has a PhD in economics. So that's when he started, and he kind of pulled me back into the industry with that vision. He said, look, yes, I know the industry is not what it used to be, and I know how you feel about it, but I think we can really be this reliable ally for brokers, where we can be flexible and reliable, and we can share that knowledge because we've done that before. So we know how it's done.
100%.
We know how it works, you know. And if you want to be a market maker, then be a market maker. But don't go, abusing your traders. Don't go offering asymmetric slippage and so on. Like, look at the spread decay. Look at what you have, you know, and look at the flow. Be able to vet through your flow to say, actually, these clients need to be in this liquidity pool. This client needs to be in that liquidity pool. And these clients perhaps are toxic, and I don't want them at all because they are trying to abuse my liquidity providers, and it's not the flow that I want to see. So, and that's how he kind of pulled me back into the industry, because I felt that we can make the difference, you know, and that's when I started actively participating in your Bourse again and in the industry in general. So now it's more of a B2B, not B2C that I started off.
Right.
Yeah. But the interest of the end client is still somewhere.
Well, I think it has to be, right. I mean, and we actually discussed this briefly before we started this podcast, is, you know, the end client, we really need to protect them. And I think it is, our obligation, if anything, right. The industry wouldn't exist if it wasn't for that end trader. And, where you got different participants who measure their business on the shortcomings of the end trader is just the wrong way to look at it. At the end of the day, a broker should just offer proper technology, correct education, let the trader actually make money if it's at all possible. But, you know, just as a trader, the statistics are, you know, you're most probably going to lose. You know, 70 to 80% of people who try trading lose their money. The same applies for just business, right? What are the stats? I mean, I don't even know if these are, but these numbers that I've heard are they are somewhere close to what is correct. And that's, you know, if you want to make money, you want to open a business, 1 out of 10 businesses make it. 9 out of 10 businesses fail within the first year or the first 5 years. You know, you just got to know what you're doing at the end of the day. And since we are in the space, and if you are a trader who's, you know, serious and, you know, actually looking at how is it possible for me to make money, you know, and that comes in strategizing, looking at how the markets work, reading these books, you know, about, you know, how to position yourself, hedging yourself, looking at the, you know, the depth of market, macroeconomics, etc., etc. The least that we can do is make sure that the technology that they're using and the brokerages that are offering the services, giving them access to those markets, are actually doing it correctly. You know, that's the least we can do. So, so I know you mentioned, you know, about your husband, Alex, right? Andre, sorry. Andre, proper veteran in the industry. I think his involvement also with MetaTrade, I think there was good involvement there with the development. I think, you know, if it dates back to before 2000, I'm sure it was with MetaTrader 3, which had
MetaCharts even. Like, I think that's
MetaCharts, yeah. Wow. So that's been like the Windows 95 of MetaTrader. And that is a lot of bugs must have been ironed out through, you know, the journey of businesses like Alpari, you know, the Arwandas of the world, and who. So yeah, and when was your Bourse started?
So technically, the firm was registered, like, if you look at the company's house register, that's like 2013. But that was just an idea, and we didn't quite even know which direction it's going to go. But I'd say that the first line of code was written in December 2016, January 2017. We onboarded our first client in June 2020, if I'm not mistaken.
Oh.
But I mean, you know, just coming back to your point about the end users, I think, and I stand by that opinion, we can feed the hunger of trading with our integrity intact. You don't have to go, in order to be successful in brokerage business, you don't have to go abusing your traders. You can do it with the right technical stack, the right way, based on the best practices within the market, if you know what you're doing, if you understand the real concept of market making, and not just trying to find, like, asymmetrically slipping your clients or things like that. So,
Yes.
and that's what really our journey is. We provide the best tools to the brokers so that they can have that competitive advantage. They can offer what they want to offer to the end users without having to go and do something rogue, right?
Right.
So
there are two really important topics based on what we're saying here that I want to maybe expand on a little bit. And those two are, you mentioned asymmetric slippage, and we can get into the details of what that means. And then also you mentioned toxic flow. And when it comes to toxic flow, and on this podcast I've repeatedly said about bad participants from the B2B space, where there's brokers, or not brokers, scammers, right? Or bad participants that have the wrong incentive. On the flip side, there are also traders who abuse, right? There's also that, and I've never actually discussed that on this podcast, and I think that is a really important topic as well to discuss. So let's start with the asymmetric slippage. So slippage, as I know, is in the very basic description is, I'm a trader and I have does it apply to opening a new position? Well, okay.
You see the price and you open a position.
You see the price, I send a position, the requested price, I as a trader from my trading terminal requested a specific price, an X price. And what I get
You're placing
back,
a market order, right?
I'm placing a market order. It's sent to the market through the technologies that we're talking about. MetaTrader or whatever trading platform, to your Bourse, which is the bridge, and et cetera, right? So the price that comes back is not the same as what you requested. And slippage could be to your favor and also against.
Correct.
And it all depends on demand, supply, the quotes that are happening in the real market.
Correct.
So expand on that point.
Sure. So when it goes through the bridge or gateway, so MetaTrader 4 is the bridge and MT5 is the gateway, or fixed API session, doesn't matter. Then it arrives to a trade execution engine, and it can be anything, right? Majority of technology providers in our field are aggregators. So they aggregate different liquidity feeds, or doesn't matter, different liquidity providers, and that's the price they stream into their platforms, and that's the price they execute against. Now, they can then send it to the liquidity provider, and that's the real market's conditions, right? They send it to the liquidity provider, and it can be, as you said, in your favor or against you, because the market, the price has moved, right? We have a matching engine, so we have a central order book. So it gives you a bit more technical capabilities, but for asymmetric slippage, what that means, and in general, what best execution means, is that if there is a slippage in the favor of the client, you have to pass that on to the client.
100%.
Now, there are a lot of technology providers who do not only allow asymmetric slippage, meaning that if the slippage is in favor of the client, they still give the client the price they requested. But there are also technology providers who artificially add that slippage on top.
Against the favor.
Precisely.
Which is so bad.
Precisely. Right? So, and the thing is it easy to do? Yes, it is. Like, technologically, it's very simple. It's not. But do you really want to use that? Or do you, you can have a B-book, and fair enough, you're market making. But then at least have the decency of, having several layers of liquidity the way it is in the real market, and do price it accordingly. Say, there will be, it's a market depth, right? So the markup will be higher if you execute more volume, It's possible, but make sure that you actually adhere to the standard of the industry. And I think we really, really don't need to do that if we want to continue all working in that industry.
Yes.
Now, regarding coming back to the toxic flow, very often in this industry, what brokers see as toxic flow is a profit-making flow, which is not toxic. Profit-making flow is fine as long as you price them correctly. And that's where the whole mechanics of the industry breaks. When instead of pricing them correctly, they try to pass them on to the liquidity providers, meanwhile offering them the same conditions they would offer to the standard retail flow. Now, from the banking point of view, at least when we all had a PB, when we were working with banks, what toxic flow is when the dealers had, for example, would want to abuse the latency or would have some inside knowledge, or, for example, because of course the market has a depth, right? And the banks are streaming certain layers of volume. And they have different algorithms. They have price regeneration algorithms. There are a lot of different things they do based not just on speculation, the way our industry is based, but based on their internal needs. And so they will be posting the bands of volume. Like, I want to buy Euro USD at this price. I need 100 million, for example. And they want it felt. And what they see as the toxic flow is that in the same microsecond, not millisecond, microsecond, they get hit on that band from, let's say, 10 different venues. So they wanted to sell 100 million, but instead they sold $1 billion, right? So that's what they saw as the toxic flow. Someone who's trying to, well, I can't say front run, but is trying to get more volume at a cheaper price.
Got it.
And that was what's considered a toxic flow in a real institutional industry, not someone who's making money.
Right.
And that's where I see the problem is that we have changed or broken down the mechanics of the whole financial market so much that we have brokers who say we're market makers and that's how we can offer you better conditions, trading conditions. Fair enough. But when you go against the rules of nature, where you offer zero spread and you offer swap free and you offer this and you offer that, and you do not adhere to the rules of the market, or you do not vet through your flow, okay, fair enough. You have a profitable trader. He's really good at trading. I'll put him in the other group. Charge him a little bit of spread. So there's at least you can have that spread. You can capture that value in the spread, instead of actually abusing him, artificially changing his, so and that's what we stand for. We help brokers be profitable and successful and offering those conditions to the clients without having to really be rogue and change those conditions and go against the clients.
Right.
Because I think we all live in that industry and we all need to take care of it.
100%. So just for also my understanding, these bands, right, that you mentioned that the banks price and they say, I need to fill 100 million at this X price. How do they come up with those numbers? If I had to take a wild guess, and this goes a little bit out of the scope of the services and the work that I do at DGM, but I mean it is kind of linked, and I think, and you can maybe expand on this, is it's based on how the banking sector works and the macroeconomics, housing loans, the growth of a specific industry. We're in the Eurozone, whatever it is. Housing in Estonia is in high demand. Many people want to invest and develop, and then so loans becomes one sector, and then whatever other the banks do. Also export and import, right? So the US, how does that, loans in the Eurozone impact the euro dollar in terms of what the price is? So, and that's how these bands are filled or created.
Or their obligations or other asset futures forwards, like all of that. They look, of course, at their own needs, and or in general at their exposures or their obligations, for example, or
infrastructure, health, whatever it is.
Exactly. It's all, of course, we can't, different banks would have different needs, but they have algos, and those algos decide, and they have signals. And as you said, they look at macroeconomics event, and events, and then those algorithms derive whatever they need to price.
Right.
So they don't care.
Yeah.
They don't care if you're making money.
Yeah.
What they care about is that they need to fill that.
Yeah, because they've got their agenda.
Yeah.
They've got their business to do. And, what I always like to do is break it down into basic examples in, real life examples, because this conversation can get maybe complicated if you don't know, algos and tiers and slippage and whatever it is. And if you had to think of just of like the basic market, right, I think that can resonate with many people. And in your description about what toxic is, I'm going to link that into a different metaphoric example. So, for example, you've got an event, right? And it's let's say it's a UFC event. And, the UFC, they base their pricing on the seats. The front seats cost so much, et cetera, and it goes out. And cheap as you go out. And some guy decides, I'm going to buy out this whole event and I'm going to price it differently. That's toxic. It kind of breaks the model of the UFC, right? Because, if you're going to buy a ticket up here, which normally should cost $100, but because somebody snatched it from before and it sold it to someone else at the secondary market for $1,000, that's not good. That's toxic. I think that, is that analogy correct, or is
I'm trying to think in those perspectives. I think what is important here is that everything has a price, and what we try to do I think brokers got so spoiled by the fact that market was really volatile for the past few years that they forgot that actually there are mechanics behind this market and they work the way they work. And they got so spoiled with just people losing money and markets being super volatile that they thought we can give this for free. So zero spread, zero swaps, so on. We can provide a trading experience for free. And those conditions that are artificial without actually having proper risk and tech to back them in offering these conditions, right? So, and toxic is more about, yes, you could say I've snatched all that volumes, and if the UFC didn't know about it, then in a way, and they're like, oh, why? But it's not very abusive to them because they still made the money they wanted. But if they've managed to buy, like 10,000 seats at the price of the first 100 they were selling, then that's what it is.
Right.
So it's more of...
It's obviously more complicated, but I guess maybe along those lines, something close to. just so that we'd say I didn't give a completely crap example.
No, it's fine. It's fine. Honestly, it is fine.
So, okay. And it took 4 years to develop the code of what is your Bourse's bridge today. And actually, I don't know if we...
Don't call it a bridge. A bridge is a very tiny piece of technology
Nice.
From everything that we offer.
Let's expand that. And before you do that, I don't know if I asked you before, what does your Bourse stand? What does Bourse mean? Your?
Your, yeah. So it's an old Anglo-Saxon word for exchange.
Right.
And the reason why it is your exchange is because we really do have a matching engine at the heart of the platform. So it's an exchange-like technology. So, and it has unlimited volume bands. So usually you would see in our markets, it's quite standard that like a liquidity provider, tier 3 liquidity provider would stream like 5 bands of volume. Mm-hmm. But in other asset classes, if you look at the exchange where people are selling and buying shares, the volume bands are pretty much every single order I placed.
It's the different price.
Yeah, it's just that's it. Yeah. And the matching engine allows us to have, speed unseen in this industry before. So we can do 500,000 order events per second on one CPU. And we have that unlimited market depth. And we can also match the orders of clients together. So if one client wants to buy and the other one wants to sell, we can match that, as long as you charge spread on top, of course, because that's what you're going to capture. And it also gives other capabilities, right? But the matching engine and the ability to run that central order book, or for some, ability to run dark pools, that's what makes us stand out, because we're not just an aggregator. And the bridge is just
the connection.
It's like, it's, I don't know, 3-5% of what we'll, even less. It's just an ability to connect to that MetaTrader 4. The gateway is just the ability to connect MT5 and process those orders in a correct manner.
Right. I think this is a good example of how a lot of terms used in the industry is generalized. So when one talks about bridge, we also obviously mean all of that, but it's not actually, if you had to break it down, what bridge is actually, it's actually the connection to the technology that is an exchange, which is a whole lot more than just a connection.
Correct.
And another a good example is where brokers say a CRM, right? I want a CRM. And then by what they mean by that is also want a website, also want a client portal, also want a wallet, want all this other stuff. But
Pam, ma'am, everything.
Everything. And they mean that all, but that one, small acronym, I want a CRM.
I know. And it's, and sometimes, sometimes it's actually funny, because you would get someone who comes to you and they understand what they ask for, and then they start asking like questions that you don't expect, and you go like, wow. That's
100%. Okay. So let's talk a bit more about your Bourse's technology then, and what that is, that it's a lot more about. So we mentioned, the exchange, matching clients' actual orders. So, if you look at a play, so you also mentioned dark pool. I think that's also a good topic to discuss. Actually, the first place where I learned about dark pools is in the book, if I remember the book correctly. Flash Boys.
The really thick black book you're probably talking about.
No, I think it was a small one. It was an audio, so it was an audio book. Flash Boys. It's old. So they talk about the importance of the high latency and these dark pools, which if I remember correctly, it's just it's
it's pretty much, so you can allow a certain, so if you have enough volume, which you can do, you can create a separate pool of liquidity for certain market participants who can only trade there. So it's a locked community, and it's not regulated by any other market conditions and so on. So
it gets it derived, let's say, the quotes that are in, and then it serves as this,
and they trade between each
exchange in its per se, let's say, by itself, in its own entity. And then the your Bourse technology stack allows for multiple dark pools to be created.
You can create as many as you like. To be honest, we don't really have that degradation. So with us, very often when you'll look at the traditional retail CFD technology, some of them can't even run the liquidity pools. And if they do allow that, then they would give you a few because of the infrastructure, architecture, and so on. With us, you can have unlimited liquidity pools, and then you can decide how you want to route these orders to different liquidity pools, how you want to price things. So it just gives you a lot more flexibility. And it's not just applicable to, let's say, retail brokers. It's in general, like hedge funds could use that. So it's just not a standard approach. It's more of an institutional approach within the retail space that allows you to be a true market maker, that allows you to do a lot more than just, either be book and take the risk without understanding what you're doing, or pass on the trade and actually make a loss because the market is a lot more expensive than what you end up offering to your clients.
Right. So, from my perspective, in a way, I appreciate and understand, your feelings towards, I miss how things used to be before the S&B event, because, that's when it was actually legitimate and things were connected correctly. But I think as things evolve, if you want to be in this business, if you do not know how the actual market works right now, and we actually also discussed this a little bit before, right now the brokerage, the business owners who are opening up brokerage firms and don't actually know these specific details, which are important to know, they're getting away with being able to sustain their business by the statistics that are to their favor, and that's, the traders.
They were getting away with it. They were getting away with it, but we see
the market's getting smarter, industry's getting smarter.
It's getting like at the moment. I don't know if you've noticed it, but we've discussed it. You did, yeah, we all did. So the market is challenging right now, and it's very flat. And we see that the brokers who don't really know the mechanics of true market, they are really struggling and suffering because they can't continue, hoping for the best.
Right.
They can't continue just bucketing that risk and hoping, as it is with volatility, that the clients are going to lose money.
Yes.
And especially with, a lot of carry trading as well. You can't do that, especially in the flat market. And that's where I hope, market can't stay like that forever. But I really hope that it's going to be a way of maybe more of a wake-up call.
And also, I think flashing out.
Yeah.
As it's not good for them, but at the end of the day, if you want to be and participate in this industry and offer, a proper brokerage business, and you don't know, at least get people who do know to help you, or you're going to get flushed out. The market resets. These resets are good, and it's important what you said there. Now that it's flat, it does not necessarily mean that volume has stopped. You can still make money because, as you mentioned, the banks don't care if you make money or not. They just want to fill, right? Or the exchanges, they just want it filled for whatever their agenda is. So there is always possibility to make money, even if there isn't volatility that the clients try to speculate on and increases volume, which would generally helps a broker to make money, even the ones who don't know what they're doing. So such an interesting conversation. And I think this, what you mentioned before, that the average lifespan of startup brokers is 1.5 years. Like if you haven't managed to sustain yourself in 1.5 years, you mismanage the business. And I think also, in terms of, how this industry is expanding or not, you mentioned before, and I don't think we mentioned in the podcast, it was just before, it's shrinking. There are obviously, new generations, the younger generations who are up and coming, and I think with platforms like this, as long as you're educated and you know that there is a possibility to make money, and this is actually a proper industry, this I think will help generally, and the more content there is out there to educate the younger generations, and also existing people who know what they're doing. Maybe you can get really good conditions from a smaller broker than you would be able to, with smaller capital, than would you be able to if you had access to the bigger players where you might not be able to. So,
well, there will always be trading hunger to feed. It depends on how you feed it and what value you derive from it and what value you give to your clients, right? And and we've discussed that, yes, the industry, the retail CFD industry is shrinking. And there are a lot of reasons for it. And we do host events such as Dealer Connect in Cyprus, and we get a lot of dealers. Like last one, we had 120 dealers there talking about those things. And that actually came from one of the panelists on that event. And what he said is that based on their research is the industry shrinking by almost 5% a year, but it's growing by 20%. The number of brokers is growing by 20%.
Yes,
so the question is, what are those brokers doing? And they are eventually closing down. I mean, we have a lot of really strong names at the top of the industry, and they're there to stay because they run the business properly. But I'm very excited about coming back to the flashing out. I'm really excited about what's happening in the crypto world. Because yes, the trade, there will always be hunger to feed, but in the crypto world, I think we're looking at something that's been happening with the CFDs industry before. Maybe there will be some public executions, but we also see European regulators stepping in and saying, look, these are financial services. It's not gambling. These are financial services. For example, FCA, very respected regulator, going to implement the promotional rules, right? So you have to follow the same rules when you run a promotion as you run if you do it in retail CFDs, right? And there will be mechanics of offering those services. And when there are those mechanics and when those services are offered, it becomes a healthy industry. And I guess that's where we will all kind of expand into. Same as like Fidelity or BlackRock wanting to have Bitcoin ETFs and actually fighting for it. And I think there is a great future ahead of us. It's just about capturing that opportunity and going back to the correct market mechanics and understanding I think it's a great opportunity out there.
I agree with you, and I think what makes that opportunity even more interesting is the fact that we've got all this history with how the fiat, the fiat CFD market worked, right? So, what the do's and don'ts, and then apply that. All that knowledge that exists, that as you mentioned, the mechanics, as you put it, and that is, the regulator knows at least how to properly regulate and, come in new era, crypto, digital, things are changing, the way the regulator is going to apply the rules and the licenses around that is going to be a lot better, with backed by a lot more knowledge than what the regulators had many years ago, right? So
as long as they don't want to kill it, but I hope they won't. It looks more like they're also looking to regulate it instead of killing it.
Well, can they kill it? That's the thing. All you're doing is when, if you're a regulator and you want to kill something, what you're doing is you're not killing it, you're pushing it away.
Yeah, you're pushing it offshore. But that's what we've been through already, right? Yeah. So it's actually coming onshore.
Right.
And I think what SEC is currently doing, they're trying to push it onshore and say, well, this is not a proper way of running business. You have to run it as they said, right? Some cryptos, they have the mechanic of a security and it's a regulated activity. And if it's a regulated activity, then you have to comply with all the rules. So yeah, I'm hoping there's going to be a renaissance of retail trading industry, so to say.
Looking forward to it. And is your Bourse obviously at the forefront here? Are you ready with crypto?
We have the matching engine. If we look at the retail financial industry, we are the only one who has a matching engine. So
nice. Elina, believe it or not, it's been almost an hour. It goes quick, right?
Yeah.
let's do some closing comments here. Thank you, Elina, so much for your time. This was a really good conversation. It was very insightful. I think there's a lot that we're going to cut up into chunks over here and post on social media.
Post everywhere.
We're going to make you popular. More than what you already are. So thank you for your time.
Thank you, Dino. Thank you for having me.
Let's do some closing comments. Where can people find you?
I'm very open. I'm very open to conversations. I mean, I'm very approachable.
You are.
Yeah, so LinkedIn, anyway. I make it a rule to always answer people who approach me on LinkedIn, even if I want to say no. Like, even if someone is trying to sell you advertising or technology, which happens to me often, they try to sell me technology. But I always kindly say, look, this is not. But so I always respond. Good.
I mean, that gives the person on the other side closure, to some extent. I also try to do the same sometimes, but now you've incentivized me. I'm going to go to all the messages that I have not, and I'm just going to give
2 days.
Yes, I don't want to take that long because I also generally follow that.
Okay.
Good. Thank you very much, Elina, and it's a wrap. Boom.